All right, welcome everyone to the third Thursday Themes webinars here with CAZ Investments. I'm very pleased to welcome two good friends of mine, Kyle Kafka and Brad Thielman from NCAP Investments. Today we're talking energy and the theme of energy. And so, I'll put this one out there as a high level. Brad, Kyle, give us a little bit of background on yourselves and your firm and the theme that you guys are most focused on currently within your business.
Sure. Thanks, Mark. I guess I'll start. I'm Kyle Kafka, as Mark said. NCAP Investments at our core, we're an energy manager. And so we've been around since 1988. We were founded by four gentlemen who came out of Republic Bank of Dallas. They were originally doing energy lending to the E&P space specifically. All four of those founders are still involved in the company today. Brad and I are partners at NCAP. We've been here for about 20 years. And the firm has evolved over time, and today we remain energy experts, but we're involved in several different energy verticals. So really at the core of what we do, and a lot of what we're going to talk about today, is still investing in the E&P space. But in 2008, we also started a platform that specializes in midstream investing. So, primarily the pipelines and processing facilities that help get that oil and gas to market. And then more recently, in 2019, we partnered with a group of individuals to start making investments in the energy transition space. And that effort has been primarily focused on investing in the North American power grid and taking advantage of all the capital that's going to be deployed in order to continue to transform the power grid into more and more renewable sources of energy. But having said that, as we sit here today, we still see huge opportunities to invest in what we call the traditional oil and gas space. We think, the global energy demands that we're facing as a world are substantial and significant, and it's going to require all different types of energy in order to meet those global demands. And we'll talk a lot more about this today, but we think oil and gas continues to play a huge role in that. Specifically within our funds, our strategy is to back management teams. And so, rather than Brad and I running and operating those oil and gas assets on a day-to-day basis, what we do is we go out and find what we think are the best, most talented teams in the space who have a track record of successfully investing in oil and gas, so successfully building oil and gas companies up and selling them over time. And we go partner with those guys. We provide them with equity capital in order to go pursue those opportunities. And really, we act as risk managers at the board level to help make sure that as we're deploying that capital, it's being deployed in areas where we're creating value, and we're quick to step in and ask questions and halt activity if we see capital being invested in places where we're not creating value. And so I think that strategy has served us very well, again, over a very long period of time, since 1988, and we continue to pursue that same strategy today.
Perfect. Thank you.
Great summary there. Maybe just add a couple things, Mark, just to give context, right? We've raised 24 institutional funds over the last 35 years since NCAP's was founded. Roughly about $40 billion of capital across those funds. And one of the key themes that we see, Kyle talked about people, and it's such a big part of what we do, backing the right people and the best management teams. As far as our team, Kyle and I've worked together for almost 20 years here as partners at NCAP. And the consistency of the team and the culture is one thing that kind of stands out through a lot of different cycles and a lot of change in our space, clearly over 3 decades. Very consistent people and strategy, as Kyle touched on.
Yeah, they're certainly one of the stalwarts in the energy private equity world. One of the things for folks who know CAZ very well is that we're very focused on the downside scenario of various investments, right? We're personal investors in everything that we're doing. So it's our capital going in. And that is one of the things that has really stood out to us about NCAP over the years is you guys are also very focused on risk mitigation and protecting capital. And so let's talk about those worst case scenarios. How do you guys think about the downside as you're not just getting ready to back a management team, but when they're ready to make investments, either make acquisitions or put the drill bit in the ground, whatever the capital expenditure is for, how do you guys think about and how do you manage risk?
Yeah, no, I think, from a mindset standpoint, very similar mindset at NCAP. We're very focused on risk management. It kind of goes back to what Kyle mentioned at the very outset with the founding uh, four people that founded NCAP. They were all coming out of Republic Bank of Texas, had a credit background. A big piece of our senior leadership team today had some sort of credit background, right? So when we walk in every deal, as you mentioned, we're thinking about capital preservation before we even have a discussion about returns or growth. And so a big part of what we do is risk management. And across, 35 years, we're pretty proud of the fact that we've never had a fund that's lost money through a lot of different cycles and a lot of volatility in our space. And a big part of that is, how we think about it is we want to control every investment that we make. So when we back with these management teams, they're clearly partnerships. We're backing what we think are the best people in the business, but we have control. We have board control, and that allows us to make quick and nimble decisions with our management teams that are really focused on economics. We use limited leverage is another thing that I think is key. We're not here trying to go build businesses by financial engineering certain returns. We're trying to build businesses that somebody else wants to buy, but do that in an operational way. And so as we look at risk management, as we think about managing risk, those are some of our core tenets. We're focused on economics, and we stress test everything that we do. So when we're looking at a deal, we spend a lot of time trying to understand. We have a technical team here that helps us evaluate and normalize risk, whether that be geologic risk or engineering risk, and really kind of put a framework around that so that we can stress test that and understand what those potential outcomes could be. But to be clear, we're not taking exploration risk. We're going into known areas. And so we got to mitigate risk by going into those areas. So we feel really good about, the places that we go and the assets that we buy, that we have a good understanding technically. And then on top of that, we want to focus on the top quartile type of properties. We're not looking to go into second tier or third tier type of properties. And we found that as you build business, if you're in the top quartile of the cost curve, right, in our space, that those returns are much more resilient. So we use hedging. We spend a lot of time thinking about limiting long-term commitments that would cause us to maybe go drill in an environment where you normally wouldn't want to go drill. I mean, I think probably the best case study, Mark, would be almost 4 years ago today in the spring of 2020. When we probably had the biggest shock to the system that we could imagine in the energy world, right? We were staring at a screen that showed negative oil at one point in time. How we reacted to that is a pretty good, I think, case study of how we think about risk. And certainly that was a shock to the system. And as we looked at our portfolio at the time, just to give you a sense, we had about 20 rigs running in January of 2020. And so as we got to March and April, obviously the world was turned upside down. By the time we got to June, we had 0 rigs running in our portfolio, right? And that's important because we didn't have any kind of public targets that we needed to meet. We didn't have long-term commitments. We wanted to make economic decisions. And so, the ability to go do that, to control our investments, to work with our management teams, to be very nimble in those types of time periods really allows you to manage risk and preserve capital. And then ultimately, hopefully allows you to go back on offense in times when we see dislocations.
Yeah, I can remember that time well, walking around my own neighborhood and visiting with some of your colleagues, and everyone was saying this is both the best opportunity we've seen in our careers and also one of the most frightening times. Every business faces challenges, right? I know we face challenges every day within our own. Challenges aren't necessarily problems, but what would you guys say is the biggest headwind or the biggest challenge that you are facing and your portfolio companies are facing in the environment today? Not obviously, we're in a very different price environment, a very different world than we were 4 years ago when we went through the COVID pandemic. So what's happening today that's causing challenges in your world?
Sure. I think, Mark, as you mentioned, in business, there's always challenges. I mean, we're going to get in a little bit to the opportunity set here in a moment, what has us so excited. But honestly, one of the challenges facing our business today is the lack of capital. And so, it really is different today than it was 10 years ago. 10 years ago, our business was overcapitalized. So we had, the public capital markets were wide open. There was, call it 100 public E&P companies. They could easily go access public capital in order to raise funds for growth. And that growth could be in the form of raising capital to go drill more wells. So pick up additional rigs to drill new wells and increase the rate of production of the business, i.e. growing their cash flow. They could also go raise capital in order to make acquisitions, go buy other businesses in order to grow their business. That was the public capital markets. On the private side, there was lots of sources of private equity available. And so, obviously we specialize in energy, but when you think about what I'd call the large generalist private equity funds, there's lots of them out there: Blackstone, Apollo, TPG, Warburg Pincus, you name them. All of those organizations were heavily investing in oil and gas, and a lot of them were raising standalone multi-billion-dollar funds to focus on oil and gas in particular. And so the industry was overcapitalized in a way, and that capital was easy to access in order to go build these companies. Today, I think one of the headwinds the industry is facing in general is that it's undercapitalized. If you look at the public capital markets, there's far fewer public companies today. It's probably been cut in half than there were at the time. And then there's a lot of pressure and focus on these public companies rather than to grow their production, to provide a steady production profile and use a portion of their cash flow in order to provide a dividend back to the shareholder. That's been instilled in the public markets over the last several years. I think it's worked well. As a result, energy has been one of the top performing sectors in the S&P. But these companies are no longer focused on growing. They no longer have easy access to capital. Really, they have to live within the cash flow that they're making from their existing production, use a portion of that cash flow, call it 60 to 70%, to go out and drill additional wells to hold production flat, and then take the remainder of that cash flow and send it back to the investor in the form of a dividend or a share buyback or something that's accretive to the equity holder. And so capital is precious in our industry. I think on the private side, we've seen a lot of those large generalist private equity funds leave the space. A lot of it for, ESG reasons. And so, as a result, one of the challenges in our industry today, I think for both public and private operators alike, is accessing the capital they need to go capitalize on the opportunity set that exists today.
Let's talk about that opportunity set and turn a bit more optimistic. What got you guys excited? I mean, you got out of bed this morning, you came into work, and I presume it's for more than just a paycheck, right? There's a lot of places to go make an honest living wage today. What are you guys jacked up about?
Probably a little bit along the same themes, right? The biggest challenge is that lack of capital, and it also kind of creates what we think is some of the biggest opportunities, some of the best opportunities that we've seen in the last 20 years from a risk-adjusted standpoint. And so, for those that have access to capital, it's not such a bad thing when that capital goes away. In a way, right? There's less competition. As Kyle mentioned, we had 10 years ago had over 100 public E&P companies. Those are 40, probably 45 to 50 today. You have 30 private equity funds in our space that had more than $1 billion of dry powder. 5-7 years ago, that number is probably less than 10 today as well, right? So it's created some opportunity to go buy assets at some of the most attractive valuations that we've ever seen. And certainly as we've seen in the last 10 to 20 years in our space, right? So you think about valuations back in that, Kyle was kind of describing that easy access to capital, go shale days, of a decade ago. Companies were generally trading on an enterprise value to EBITDA range 8 to 10 plus times. Today, companies in our space on the public side are trading around 3 to 5 times. And so we have ability to go buy assets, and we'll touch on this as we get into the opportunity set in greater detail. But we've had the ability to go buy assets over the last 3 years, really high quality assets that have a significant amount of cash flow and production. Buy those at 2 to 3 times EBITDA multiples. So that gets us excited on the front end, right? As we talked about downside risk, if you manage your risk and you're buying a quality business at 2 to 3 times EBITDA, we get pretty excited about the ability of our teams to then continue to go grow that platform and create value. And I think the other thing that we don't talk about here at the lead in on the opportunity set is that our industry is pretty healthy today, right? So there's been periods when you've had a lot of over leveraged companies in our space or companies that weren't spending money efficiently. Today, Kyle talked about that discipline that we're seeing from the public companies in our space, and it's really creating pretty strong margins and really good drilling and development opportunities. So we can go buy right, and then we can also go grow the companies, right? Because we're not sitting still when we go buy an asset. We want to continue to go grow those. And in our space, that means going and drilling and developing these properties. And we're seeing some of the best returns, like I said, risk-adjusted returns on our drilling programs that we've seen in quite a while. We actually just did a look back with our technical team here about 2 weeks ago, as we look back on every single well that we drilled back in 2023, kind of the good, the bad, the ugly, about $1.5 billion of capital that we spent. And the punchline was that across all those companies, the average return was a 2-to-1 from a discounted ROI standpoint, right? So you drilled a well for $8 million. As soon as you turned it on, it had a PV10 of $16 million, and it was around a 60 to 70% rate of return at current pricing. So that's everything, actual costs, and actual performance. So when you can go redeploy capital at, those types of rates of return, you can go buy assets at 2 to 3 times. That gets us excited. And maybe, touch on, one of the questions we were getting a couple of years ago. That's great, but can you go sell your companies? And I think, over the last couple of years, I think we've answered that question relative to distributions. Maybe we'll touch on that, Kafka.
Sure. No, I think, like Brad said, the opportunity set, fantastic. And we have been able to translate that into, really attractive distributions. We've sent back $7.8 billion last year to our investors, both in the form of cash flows and exits, and about $5 billion the year before that. And so it's been a very healthy environment for us to, not only find great investment opportunity, but be able to send cash back. I think that, on the exit front, we had a handful of large strategic exits last year. We think we have some opportunities to continue that this year. And what I would tell you is, the market has changed from 10 years ago, when there was a flush amount of capital out there and people were being rewarded for growth. But to the extent that we can go build opportunity sets that are really fit what the remaining publics are looking for, which is they have scale, they have a lot of cash flow, and they have a healthy inventory of remaining attractive locations. We found a captive market for those folks to want to come buy those assets. And so what we're really looking to do is build those scalable assets where we can attract call it 10 to 20 to $30 billion public companies to come in and buy these asset bases where they're accretive to them on all those different metrics. And importantly, that inventory of undrilled locations and development opportunities is something that they're really looking for, because they have been disciplined drilling their own asset base for the last several years. And as you continue to drill that asset base, your existing inventory of remaining locations shrinks. And now what the public market has started focusing a little bit more on with these public companies is, okay, it's great that you've provided me a good dividend over the last 4 or 5 years. I like the cash flow. I like the fact that you've got a strong balance sheet and it's steady. But now, as we look into the future, how are you going to continue to deliver on that for the next 5-10-year period? And part of that has to do with, well, what kind of attractive projects do you have in your inventory? And so some of these companies that we're building are built for purpose to help replace that within the public companies, where they can bolt in the cash flow on an accretive basis, but then also receive an attractive drilling inventory of economic locations that really fit with their business today. And so, again, that's what we're looking to build. We've done that successfully over a long period of time. Had a lot of success with those exits last year, and we think there's more exciting things on tap this year as well.
Yeah. So, very simply, right, as you think about what gets us so excited is you can go buy it right, you can go grow it, and then you can go sell it. And we don't think you're having to take, we think from a risk-adjusted standpoint, we're in areas that we really know and are well-defined. So you add all that up, and that's what gets us pretty excited about, what we're doing every day.
So let's quantify that excitement, right? Most people use 1 to 10 scales. We use 1 to 7 here at our firm, just because it helps people be a little more discerning with their numbers. I often ask my friends on a scale of 1 to 7, how do you like something? And they sort of look at me like, that's a weird way of doing things, Mark. And I say, well, that's just, think about it a little bit. So and you mentioned you guys have been doing this a long time, you guys there 20 years and the firm being around a lot, even longer than that. So on a scale of 1 to 7, 1 being absolute worst, this is painful every single day, to 7 being like, you know, everybody's throwing a party. Where are you guys right now for the excitement and the level of opportunity and the risk reward in your area today?
You know, I'd say we're at a 7, Mark. I mean, honestly, we hit on it a little
Let's
bit.
go.
Yeah, not to get into this, you know, we don't want to worry about getting into specific transactions, but Brad alluded to it, and I would tell you that, you know, you said risk reward, which is exactly how we think about life, right? And we think that given the market you're in, there are always different opportunities, given the capital market, the opportunity set, the price to go make investments, and part of our job is to navigate that and figure out where that is. And I would say that today is very unique, and it links back to that lack of capital, but never have we been in a position in our careers where we've been able to compete on buying assets with cash flow at value that we think is intrinsically attractive, right? And we can underwrite to our equity rates of return. But then on top of that, also having the opportunity to go out and develop the asset in an extremely attractive, high margin way that Brad mentioned. Typically, in the history of being here, both of those things aren't true. You may have the opportunity to go buy assets at a low value and attractive price, but perhaps you're in an environment where the development opportunity is not very attractive, right? Or we're in an environment where the development opportunity is attractive. It's really expensive to go buy assets. And today, for the first time ever, we're in this kind of Goldilocks period where we're finding we can go enter these assets at very attractive prices, but then the development margins are huge. And, you know, Brad touched on that, and just to kind of re-highlight it, drilling economics in oil and gas are not complicated. There's 3 things that go into it. 1, at what price are you going to sell the product? So what's the commodity price? What's the oil price? 2, how much product are you going to get out of the ground, right? What is the well going to produce? And number 3, what is it going to cost you to drill that well, right? It's like a real estate deal. What is it going to cost you to build the building? And, you know, obviously we've got a constructive oil price environment. We're going into these areas that we've now drilled for a number of years where we really understand the recoveries. We understand where to drill the wells, how to space the wells, how to complete the wells, and the risk of the recovery has gone way down. And again, we're focused in some of the best areas in the United States. And then number 3, on the cost to drill the well, due to that lack of capital and the capital discipline in our industry, we're able to drill the wells at very attractive prices. And so let me relate that back. Pre-COVID, we were running over 1,500 rigs at a point in time in this country, so horizontal rigs developing assets. Today, it's around 600. And so the impact on that as the operator is, if Schlumberger and Halliburton and all these service providers aren't receiving phone calls from all the operators with their phone ring on the hook to get the equipment in the field, they don't have the pricing power to increase the price of those services. And so essentially the cost to go to drill these wells is really attractive right now. So those are the components that are lining up, making drilling economics so attractive. And I think, you know, that, and combined with the ability to enter these assets, right, really gives us the ability, you know, to enter deals at a low cash flow multiple, really reducing our risk, yet have the opportunity for an outsized return through further growth and development. So it's really that asymmetric risk return profile that's pretty unique.
Yeah, I mean, maybe it's just personality, Mark, but I'm a 6 because my kids, my teenagers might be rolling their eyes. Dad will never give me a 7, but you know, I mean, I do think it's a phenomenal environment, right? I think as you look back on prior time periods, you know, if we're really honest with that answer, you know, there's always opportunity. Kyle said that there's this trade-offs, and right now it feels like it's skewed, right? You know, and we think there's a lot more upside than downside for all the reasons that Kyle kind of mentioned. And so maybe we were at a, you know, 3.5 and a 4, and I'm at a 6+, I'd say right now. I mean, clearly from a regulatory standpoint, as you kind of think about oil and gas firms aren't necessarily the most popular right now. So there's some, you know, there's obviously some things there that I think could always kind of be better to make it a 7. We'll see where all that goes, and not to get into politics on this short discussion, but we do think it's phenomenal. I think the one thing that maybe is underappreciated that Kyle kind of alluded to, but maybe didn't touch on fully, and particularly in our space right now, that's so much different than it was, you know, 5-10 years ago, is our ability to go make significant distributions, right? We never really branded ourselves as a yield vehicle, right? We're private equity and we're growth and we have our target returns. But right now we're able to go buy, because of all the factors we talked about, a good, attractive entry price, buying cash flowing assets, and then developing those assets at really high rates of return. We're able to go send back a tremendous amount of distributions along the way. And so as we think about that as investors, it really de-risks the investments that we're making right now. I mean, just to give you a bit of a kind of an example on that, we've got a couple of deals up in North Dakota in the Bakken that we bought, one for $900 million in 2021, one for $825 million last year. And not getting into all the weeds, but it kind of fits all the things that we've been talking about and the themes that are going on. We bought it at 2 to 3 times cash flow, and we've been able to grow those business substantially. The first deal we've almost paid out. We put in $600 million of equity. We've almost paid out $1 billion in 3 years just through distributions, right? So that's pretty powerful. And the deal that we just closed on here 9 months ago for $825 million, we expect to do about a 25% yield on that investment, on the equity on that investment, just through distributions here in 2024. So the ability to go pay back deals in 3-4 years time frame or earlier, right? And then still be able to grow those and have something that you can go sell that somebody else wants to buy is pretty unique. So maybe I'm talking myself up to a 6.5.
That's great. Well, let's wrap up with this. So, there's a lot of different ways to express investment themes, right? Public, private. Why, when you think about the world of energy investing and the theme you're focused on, why is investing with NCAP a better way to do it than a traditional asset class like the public markets? What's the additional value that comes along with investing in, the way you guys do it, as opposed to just going out and buying Exxon stock? I believe everything you're saying. Great, I'll go buy Exxon stock and keep it simple. Why not do that?
Yeah, I think that our performance over a long period of time, we, again, as Brad mentioned earlier, we've never lost money on a fund. Not to get into our track record, but we've got a very consistent performance period over a long period of time. I think that stems from the things that we've touched on, right? Number one, we partner with the very best teams in the industry. Our structure is different than a public company's incentive structure. Our management teams are highly aligned with us and with our LPs, and that their incentive is not through their salary or how they might grow the company, but they have an equity incentive that's directly tied to the performance of our investment dollars. And the better our investment dollars perform, the better they perform, right? And the more money they make. And so our teams are smaller, more nimble. We have lower overhead. And we have perfect alignment with teams. We have the ability to make decisions quickly. As Brad said, we have board control. And so, as compared to, you mentioned Exxon, some of these large public companies are more like, large tanker ships that take a very long time to turn and steer with multiple layers of approval. With us and our teams, we're a phone call away. And we have a technical team here in-house that we didn't spend a lot of time on, but we can analyze opportunities and make decisions very quickly and efficiently. And we found that, over time, that's been a great formula, partnering with the best teams, managing risk, low leverage, the ability to make decisions quickly has led to outperformance.
Yeah, no, I mean, I think Kyle hit it right on the head. But when we go bet on people, you're betting on entrepreneurs that wake up every day that are aligned with you to go make money. They don't have to go deal with a lot of the bureaucracy or the things that might happen at some of these large publics. And so as we look at, there's a lot of healthy public companies, out in the space right now, but we actually think, there is a lot of excess return to get captured. We love to put our teams out and go compete, right? These big companies, as Kyle mentioned, are really good at certain things and they're not as good at other things, as relatively to be nimble, to grow, to do deals, to trade, to swap, to be creative on that. And we think right now on the private side of the business, to be able to go to grow companies, to go buy them if you have capital and build stuff of scale, we think it's a tremendous opportunity. And we would stack our portfolio companies up against the publics out there and say, hey, we're going to bet on our guys. And I think it's played out in a track record. And we think this environment is really set up to do that as some of these companies get larger and larger. we're betting on the entrepreneurs, and we don't think we really have to take any really excess risks to go generate those returns. So we're excited.
That's fantastic. Well, Kyle and Brad, thank you very much for joining us for this next episode of the Third Thursday Themes webinar. Really appreciate the partnership and the friendship with both of you. Thank you very much on behalf of everyone here at CAZ.